Right, I guess we're ready to start. Welcome everyone again, and in this panel we are going to discuss sovereignty, which is a topic that as a cosmonaut, I've been 5 years in Cosmos, it's particularly important for me because Cosmos is an ecosystem that has always put sovereignty as its first core value. Then we have interoperability, then we have decentralization. And sovereignty for Cosmos means that everyone can build its own blockchain, can customize its rails, and fully be independent as application-specific blockchain. So you don't build an application on another blockchain, like could be Ethereum or Solana, but you build your independent blockchain. And this could be very much seen like, you could see like a shop in the street that has its own building compared to a mall where you actually don't own your own shops. And sovereignty has many layers, and in this case, we will discuss monetary sovereignty and why it's very important in this phase where we have a CBDC coming in Europe, we have stablecoin adoption, and to discuss this, we have these amazing people that are leaders in their respective field. Nikola, which is a leading crypto payment processor in Croatia. We have Erwin, which is incredible for when it comes to the policy and MiCA and all the regulation that we have to navigate during this time. And Maximilian from the Austrian National Bank, which will give us a very good overview of the digital euro and a CBDC perspective. So let's start with Maximilian, because the digital euro now seems very much coming. Actually, there was a statement yesterday from the European Central Bank and the Digital Euro official page that provided some update on the upcoming regulation. But one point that I want to discuss with you is actually we have a very strong adoption right now of USD stablecoins. So how do you see the digital euro addressing this losing of monetary sovereignty in Europe over USD denominated stablecoins?
Okay, first of all, thanks for having me here. After the previous panel, I might have to reconsider my career choices now, but let's see about that. I was just joking. Yeah, it's an interesting question. We already heard in the panel yesterday about the digital euro, especially from the retail perspective. And there's a clear timeline now with 2029 in focus for launching there. We as a central bank, we look at payments as a critical infrastructure, right? So when you pay outside at the shop, most people, they don't really think about everything that happens behind such a payment, whether it's retail point of sale, buying something at the store, or whether it's in capital market transactions, when you buy a stock on your brokerage, for example, or when you transact from one account to another account. And that's where, at the background, a lot of things take place with the banking system, whether it's cross-border with correspondent banking, whether it's in crypto markets where we have stablecoins. And in all of these, like whether it's retail payments, we all know the US companies that dominate the space with credit cards, for example, or with mobile payments. So there's a clear dependence on the US companies there. And on the DLT side, when we're talking about tokenized markets and crypto markets, there's a clear US dominance as well, with USD denominated stablecoins. So from that perspective, it is of high importance that we have an independent solution and we have something in Europe that preserves our sovereignty, and that's how we look at it from a central bank perspective. We'll talk more about the wholesale side later, I think. But that's the idea here. And we all know how we are dependent in other aspects as well of critical infrastructure, whether it's electricity because of some resources, right? So, and oftentimes it's well known that there is a dependence on a foreign state or a foreign source.
Yeah, which is an interesting topic because there is two layers probably monetary sovereignty, which is one who has control of the distribution rails, and also like owning, of course, at the European Central Bank level, the management of the money infrastructure. One thing that I want to ask to Erwin, because right now it is getting a bit difficult to navigate all this upcoming regulation, and you are one of the major experts in Europe. So I wanted to ask you, how do you think is going to change regulation now that we have a digital euro coming? Are we going to see like a regulation that is going to do another additional push to ensure that there is a more solidified monetary sovereignty in Europe? What is your prediction, and what kind is your view overall on the regulation that we are going to see in Europe?
Well, I'll start with this. Europe has 27 member states, 27 different cultures, plus 30 if you count the EEA countries. Regulation is Europe's lingua franca, in pejorative terms, but otherwise it's true. This is one thing that Europe does have a lot to do with in terms of creating the regulatory frameworks that kind of bind everything from batteries and the food on your plate to how you are checking out at the point of sale to what stocks you're buying. I think from this perspective, to your point, launching a digital euro, if you understand co-badging risks, and if you understand the fact that there's a need certainly to preserve European monetary autonomy, also things like seigniorage for central banks, which wasn't mentioned, but it's clearly something from a Eurosystem perspective that's important. What do I think is going to happen in the next 4 years? I can't tell you right now. In terms of what this will play out like, I can tell you that there's broad buy-in, obviously, to push forward in the EU, in the ECB Governing Council, and there's support in the Parliament clearly for this as well. So I think right now the most important thing for the co-legislators is to understand what the actual form factor of this is going to look like, what this is going to look like as a legal instrument in law, and ultimately what the main benefits are going to be for the consumers. What are the first use cases that will be rolled out, right? So is this going to be peer-to-peer payments, point-of-sale payments, e-commerce, etc.? Because the digital euro, the retail digital euro as it's being designed, is going to have a very specific architecture and a very specific form factor. And this form factor is going to depend then on what the co-legislators decide that needs to be addressed from let's say like green, red, or yellow.
And I think that here we can start to enter more the stablecoins realm, because on the flip side you have MiCA, which is starting to address the stablecoins regulation. So do you think that today MiCA is actually facilitating the stable adoption, or do you think that there is a need to make a more stronger effort toward facilitating the regulation when it comes to stablecoins?
I think, look, from our perspective, what we want to ensure is that the regulation that's governing our industry in Europe is to the highest standard. And our members understand this, and our members support this. I think what's critical right now is, and this is a clear fact, Europe was one of the first jurisdictions to have a broad, full-spectrum regulation, not just covering payments, but covering different types of crypto asset service provider activities, covering market abuse, covering promotion, and these sort of things. And so there's a strong consumer protection element that's kind of baked into this framework. What you see in the States right now, you have a regulation that's governing payment stablecoins, but the entire debate around market structures through clarity is still, now with the government shutdown, it's been stalled, but this is something that the House of Representatives still needs to decide on. So in Europe, we started from a different position. It's much more complete. That being said, no regulation is perfect, and this is something that the Commission has said as well. So I think for us, the main thing is to ensure that whatever ends up happening with the MiCA we have now, if MiCA is ever revised, that we support the highest standard for industry, because ultimately this is going to have the best benefit for the consumers that we have that are within the Eurozone itself. So I would say with stablecoins, it's no different. Look, we support multi-issuance. I think it was also the Commission's opinion regarding global stablecoins that this is something that would eventually come. We know that stablecoins are the ones that are issued under MiCA have strong safeguards and are ring-fenced under the framework that MiCA addresses for reserves, for example, and we support any endeavors from the co-legislators with regards to this issue, and we stand ready to provide more clarity on how industry is already implementing those robust safeguards and securing the Eurozone and its payments perimeter.
Okay. Yeah, that's definitely picture very well what is the current regulation landscape. Nikola, you are more on the user-facing level, so you very much know what the user wants at the moment. So, in your opinion, what stablecoins have at the moment that CBDC don't have, especially from a payment perspective?
Well, they exist. CBDCs don't and won't for the next 4 years, digital euro. It's going to be rolled out in 2029, so that's critical difference. We talk about digital euro as if that's something that's real. It's not. And it's not going to be real for 4 years, and in crypto years, that's 150. No,
I can relate on that.
Yeah, so I think this is completely useless discussion about digital euro. Sorry for being too direct. But in next 4 years, crypto is going to bring to life payment systems that will be miles away from where we are now. And Cipollone and other European central bankers are quite clear. They don't want to support European stablecoin and stablecoin industry in general because they feel this is a problem for a future usage of digital euro. So if they feel that stablecoins at current level of development are too fierce a competition for digital euro, that they have to be curbed, then in 4 years they won't know what hit them. Because they are comparing today's stablecoins to digital euro in 4 years. They're not comparing what stablecoins will be in 4 years to digital euro in 4 years. You know, there's a difference. So I think this is a recipe for disaster. If I can also comment to Erwin's point, I'm quite sure. I'm also a CEO of CASP. We just submitted our MiCA documentation. We are going to get our MiCA license soon. And we also support a robust regulatory framework that will take good care for the interests of our customers, of course. That's a good talking point. But also our customers are using US stablecoins. Because there is no solid European stablecoin industry. For instance, we are now working with one of the biggest Croatian banks to build one of the first bank-issued stablecoin wallets in Europe. Okay. And we as Electrocoin, we are leading the technical part. You know, basically, we are building it. So we get to choose which stablecoin we'll use. Do you think we're using a European-issued stablecoin?
Good question.
No, we're not.
Because the user prefer other options?
No, because we as builders prefer it.
Okay.
You know, for instance, we spoke briefly at one conference. I spoke to guys from Banking Circle. That's a Luxembourg-based euro stablecoin issuer. Their infrastructure is not comparable to Circle. Yeah. Circle now has Circle payment network. Through their infrastructure, we can connect to whatever. Now, I'm a good European patriot, and I would really like to use European stablecoin infrastructure, but it's not usable. Yep. Why it's not usable? Because in US we have Genius, in European Union we have MiCA. So if we want to solve the problem of sovereignty, we as European Union, we have to stop hampering our stablecoin industry. We need to support the stablecoin industry. So I, as a builder, when my bank asks me, okay, so which stablecoin do we use? I tell them we use this European stablecoin because it's, okay, it doesn't even have to be better than US stablecoin. It doesn't even have to be matching level. It has to be a bit worse. And we would choose it because it's European. And this is far from okay. And why is this happening? Because you know, European legislators and central bankers are comparing, you know, apples to oranges. Today's stablecoins to something that will be issued in 4 years.
I think it's a very good point, and I think that you're seeing more over a layer of participant in the market. So stablecoins right now are faster, and you need to act fast in the market. So from your standpoint of view, actually stablecoins will have a more leverage because right now they are basically ready for this. This is very important point.
I would like to reiterate, why are we working with the bank on a stablecoin wallet? Because it's much easier right now for a bank to build a payment wallet on stablecoin rails than on traditional rails. It's easier. So we won, dear colleagues. We as an industry won because banks now want to build on stablecoin infrastructure. But it's going to be US stablecoin infrastructure.
Okay. Yeah, this is a very good point over the distribution layer when it comes to monetary sovereignty. Maximilian, from your side, we have Pontes and Appia, which is basically the infrastructure plans for the CBDC. So maybe you can speak about what are the plans there and how it's going to smooth operations for the distribution of the digital euro.
Of course. Just to mention a few points, because that's good to transition to Pontes and Appia. Of course, yeah, the digital euro announced as the retail digital euro has a timeline with 2029. But when it comes to capital market transactions, we're talking about end of next year for Pontes. Pontes, as the name says, it aims to bridge the traditional target system to market DLT platforms. When we're talking about tokenized assets and capital markets, trade and settlement happens in central bank money. For a reason, we had financial crisis, we had a lot of credit risk moments over the years, and that's why interbank settlement, especially on capital markets, repo transactions, it all takes place in central bank money. And if you are looking into a tokenized future for assets and 24/7 markets, you also need tokenized central bank money on chain to facilitate these transactions, because when we are talking to market participants, whether it's global or in Austria in particular, they are always asking, okay, we are not going to go into tokenization and into these markets if we don't know if there will be central bank money, because you won't transact with any US stablecoin there, or you also don't want to transact and settle in some stablecoin from another bank. You want the safest asset, and that's where during the last year there were trials in the euro system. Also to mention another country in Europe, Switzerland, they already have a live pilot running. It's called Helvetia pilot, where they already do transactions. And now Pontes is the near-term solution for the euro system, which aims to go live at the end of next year. There are a lot of market participants already at the front developing their solutions, Clearstream, Euroclear, Swiat blockchain, so a lot of excitement on that and a clear step forward.
This is a very good overview, and it also shows why there is also concern from the private industry, because what does CBDC bring? It's not only of course the ECB controlling the supply, but also the distribution rails, which from an effective standpoint makes it more effective, it strengthens the monetary sovereignty. At the same time, it brings something away from the private market. So one big question that I want to share with all of you, and everyone can share his perspective, starting from Maximilian, is do you see a future where there is coexistence between the digital euro and stablecoins, or you're actually going to see more regulation going to favor the digital euro, and so being more dominant? What is your perspective on the future?
Contrary to maybe some of the thoughts shared right now, we also published a paper. I have some flyers with me where you can scan the QR code if you're interested and you want to read 40 to 50 pages how BCG and the Austrian National Bank thought about all of these mentioned topics in detail. We see a coexistence. I mean, we are also aware stablecoins are here right now. And stablecoins are getting launched pretty much every week right now. There are announcements happening. The consortium in Europe was mentioned in the last panel with Raiffeisen, which is from Austria. So we are well aware of that. And until a wholesale and also a retail CBDC will come, stablecoins will already be present. But we see different use cases, as I just mentioned. Capital market transaction, interbank settlement is different to, for example, crypto trading. If you look at stablecoin use cases used by hedge funds, and it's basically for crypto trading primarily, and maybe in the global south and some other countries also as a savings and easy way to get banked if you are unbanked. But in the EU, for example, it's not it's not used for payments in a grand scheme of things, right? It's really, really minor use case. And so we just see different roles for each type of asset, and that's why we see a coexistence for sure.
Okay, this is a great answer, and also great to see that there is possible future of coexistence. Erwin, same question for you. What do you see in the near future in terms of coexistence, more contrast?
I mean, in one sentence, private money shouldn't crowd out public, and public money shouldn't crowd out private. Back in 44, 43, when they were negotiating Bretton Woods, there was a proposal that Keynes put out, right, with the Bancor network, which would have been some global, we call it an asset reference token now, but some global basket of some single unified currency, which would have been a precursor to maybe something tokenized today. We have this in the IMF special drawing rights in a very, very small quantity. I think that there's a lot of work being done at BIS level with Enbridge, with Agora, et cetera, connecting different hub and spokes. Capgemini and Swift did this with the Digital Islands experiment, showing that you can settle tokenized money against, wholesale CBDCs against tokenized assets atomically. I think the main thing is you'd mentioned, is for which market participants and for what purpose. I mean, if you look at right now, the issues we had in the DLT pilot regime were that the settlement leg was CSDR based, so we had cash. You couldn't settle in tokenized money. You couldn't settle in programmable money, and there were thresholds in terms of the limits that companies could actually transact in, which didn't make it economically feasible for them to work. So I think if we can get to a point where the cash yield is able to be tokenized. So, like, for example, if I'm a CCP and I'm asking somebody to post collateral to me, that they can do this in stable coins or they can do this in wholesale CBDCs. I think this is generally a place where we may get to in the next 3 to 5 years, potentially. A longer-term goal is going to be equivalence. So far, the United States does not seem to be supporting wholesale CBDCs, much less retail CBDCs in any broad stroke of the pen. However, there is room for so-called substantially similar, to use the language, regimes under Genius. So, for example, Secretary Bessent was recently in the UK meeting with Chancellor Reeves to discuss reciprocity in digital asset markets. What that ends up meaning, we'll see. But if one jurisdiction is taking the view that they are not going to launch wholesale central bank money, it's going to make it very difficult for the other jurisdictions that are to connect to this in some meaningful way from a settlement position. And I'm talking even beyond things like omnibus accounts. From a retail perspective, when I was still at the European Central Bank, we did, if anybody's familiar with the large payment studies that the ECB does, the last one was Space 2, which is this kind of broadband study that looks at payment attributes over a given time period. And we were looking at this. There was a small chapter that was added back a few years ago on crypto. And then, to your point, it's a very small means of payment, but it's a large percentage of investment, especially among people that are Gen Z and millennials. And so, again, how a given demographic is using what. To speak of a retail digital euro, there's no discussions at ECB level right now whatsoever to make this thing compatible with on-chain finance.
Okay.
So I don't see a space where the digital euro is going to crowd out euro-denominated stablecoins or US-denominated stablecoins in lending pools, in vaults, just simply posting to centralized exchanges. I think that we need to understand, again, to my earlier first part of the intervention, is what the form factor of the instrument is, and then to look at its fungibility and to look at its use case. And so,
yeah, which is a great bridge between Nikola and Maximilian, because Nikola, you can share the final perspective from the market, from someone that is actually working on payment infrastructure. Like, how do you see this future? Maybe coming back to the previous discussion, it could be Bitcoin instead of stablecoin and CBDC. Like, where do you see the future when it comes to monetary sovereignty?
Yeah, I mean, it's going to be hard. It's always hard to predict stuff. It's especially hard in crypto because, you know, in 4 years everything is going to change. Maybe we even use Bitcoin for payments. I don't know. But to get to your previous question, I'm quite sure we will have both. Because digital euro has this very, very important kind of characteristics that it is mandated. So everybody will have to use it. So I feel in the future, we will use, of course, bank money, Visa, MasterCard, traditional payment systems, because they are here, they are incumbent. We'll be using stablecoins because this is where innovation is happening. This is where we will see really big breakthroughs in the next 4 years. And we will have digital euros because it will be mandated. It will be forced on us. So we will have all of these free fronts. What I sincerely hope that will change is for the last few years we saw a lot of statements from the European central banks that stablecoins are useless, crypto is useless, we won't see anything with this, Bitcoin is going to zero. It seems that they are really bad in figuring out what is actually happening in the payment system. I hope this will change. They will learn something from the ongoing explosion of stablecoin infrastructure, and what we guys are building, they will look into it, not look the other way, and maybe then we actually get, you know, a usable digital euro. This is what I would really hope to see.
Okay. One last off.
Maybe just one more point, because this panel was about sovereignty. I think that the biggest predictor of what we're going to see in the next 3 to 5 years it's not happening currently in Europe, but it is happening in the United States. There are almost 40 trillion in debt, and stablecoin issuers are becoming the largest net buyers of US treasuries. Okay, so they're becoming a de facto shock absorber for the bill complex, which allows a government that finances itself by raising debt capital to be able to do so on an extended period of time. What could change, and what's the case in the short term, is that these stablecoin issuers are only allowed to invest into short-term notes. The point when they start being able to invest into longer-term notes, so they're exposed to the longer duration on the yield curve, is going to have a proportionate impact on potentially how we start viewing the evolving role of e-money issuers in Europe as a potential shock absorber for our own bill complex, because this is something that the United States is doing. They did this in a different medium and on a different infrastructure in the 1960s and 70s with the euro-dollar market, and they're doing it again today. On this, the ECB is correct.
Okay.
The point is, how do we support our domestic issuers in Europe to be able to play on the same footing, because other jurisdictions are doing this, given that most countries and regions are at debt to GDP levels that are
Which I think is a great point.
potential.
I'd like to end up with these open questions. Also, one of the best moments was definitely this agreement at the end of the session that there could be coexistence. And I think this is a good ending, because it gives hope for everyone to actually build toward the future in Europe together. And but the time is running out, so I think the next 2-3 years, but even in the more immediate year, will be super important. Thanks everyone for participating in this panel. I hope for the audience that it was a constructive discussion, and we will move with the next session.
Thank you. Thank you so much to our wonderful panelists. Thank you, gentlemen. It was wonderful. Thank you for being here with us.